Okay, so in this video, what we're going to talk about is how options are priced, and the goal is to explain like a couple key factors that influence the options price, and these kind of include time, volatility, and so on, and we'll talk about this. So there are two parts of an options price. The first one is called the intrinsic value, and this is the part of the price that's like the real and is like already locked in kind of price. And so if the option is in the money, as we talked in the last video, it has an intrinsic value, meaning if you exercise it right now, you'd gain something. For example, a call option with a strike price of $90 on a stock trading at 100 has a $10 of intrinsic value. And like theoretically, I guess you could buy the stock at 90 and sell it instantly at 100. And so that $10 is like baked kind of into the price of the option, and it's not going anywhere unless the stock price itself moves. There is a key thing you got to understand is that if the option is out of the money, it has a zero intrinsic value. Like there's nothing real yet, and it's all kind of like potential. The other kind of more confusing part of the options price is the extrinsic value, and this is where things get like a little more unpredictable. And so the extrinsic value is a part of the premium that kind of reflects what could happen before expiration, and it's based on how much time was left, how volatile the stock is, how likely it is the option to end up in the money, and sometimes just how many people are trading it, which is supply and demand. And this is why two options with the same strike price can have totally different prices because they have different amounts of time left or the stock's volatility has changed. And so the takeaway is that only extrinsic value changes consistently, and it's what causes the option's price to rise or fall from moment to moment. And yeah, and even though every option technically has two components, almost all trading strategies revolve around the extrinsic value because that's where pricing opportunities and our mispricings kind of live. One of the most important and like kind of misunderstood forces that also affects the options pricing is called time decay, and time decay also known as theta for its Greek name. And so the idea behind it is that every option has an expiration date, and the closer that date gets, the less time the option has to move in your favor. And so that loss of opportunity is priced into the option, and it erodes the option's extrinsic value every single day. And this erosion is called theta. And so it measures how much value the option will lose each day just from the passage of time and on all else being equal. So for instance, let's say you buy a call option for $3 and it has a theta of negative 0.05. That means even if the stock doesn't move at all, the option is expected to lose 5 cents in value overnight, and tomorrow it might be worth $2.95, and then so on. And so this decay accelerates as the option approaches expiration, as you can see in the chart. And so in the final days, it can drop fast, sometimes by the hour. And that's why short dated options can feel like they bleed out very, very quickly. And if the move doesn't happen fast enough. There's a key concept, and is that time works against buyers and for sellers. If you buy an option, whether it's call or put, time decay is a cost, and you need the market to move in your direction before time eats away your premium. And if you sell an option, you're on the other side. Time decay works in your favor because you collect the premium upfront, and every day the contract loses value, you're one step closer to keeping that full amount as long as the trade stays in your favor. And so the reason theta matters is because you can lose money even if you're directionally right just because it took too long. It also helps explain why cheap out of the money options often expire worthless. It's also the reason sellers have the edge in high probability setups, and it's why short dated options are so risky unless timed perfectly. Another major force behind an options price is volatility. This one is pretty straightforward. It's specific, and actually, well, to be more specific, it's how much movement the market expects from the underlying asset. Also, not all volatility is the same. In options pricing, we look at two types, which is historical and implied volatility. Historical volatility is the actual price movement that the stock has shown in the past, and it's measured by looking at recent price swings. These could be like the last 20, 30, 90 days, for instance. And you could think of it like it's the stock's personality. Is it calm or steady, or does it move 5% a day? Historical volatility gives context, but it doesn't directly impact the options price. The other one, on the other hand, is called implied volatility, and this is the number that does affect price, and it's inside the premium. Implied volatility kind of reflects how much movement the market expects going forward. And so the higher the implied volatility, the more expensive the option. Why? Well, because more expected movement is equal to more opportunity for the option to end up in the money. And implied volatility is driven by news events. These could be earnings, Fed decision, lawsuits, Trump speaking if it's 2025, and so on. It's also driven by general market uncertainty, trader sentiment and demand, and so on. A stock with high implied volatility is seen as riskier, and so therefore the options cost more, and traders are pricing it in potential for big swings. Also, even if the stock price doesn't move at all, changes in implied volatility can cause your options value to spike or drop, sometimes dramatically. A real world example would be kind of like before earnings, implied volatility goes up, and this can be because traders expect a big move. And on the other hand, after earnings, implied volatility drops suddenly, which can be known as an implied volatility crush. And so if you buy in options before earnings, the stock might move exactly as expected. But if it's after implied volatility drops, your option still loses value. And so that's why it's understanding implied volatility is so important. You're not just like betting on direction, you're also betting on volatility. Sometimes the move isn't enough or the volatility fades faster than you expected. A few things you should understand from this is that historical volatility tells you what has happened, and then implied volatility kind of tells you what the market thinks will happen, and this is what you're actually paying for in the options premium. So by now you've seen that options price isn't just about the direction of the stock, it's the result of multiple forces kind of working together and often all at once. And so if we were to pull it all together and talk about why option prices change consistently, even minute to minute during the trading day, is because of stock price movements, time decay, supply and demand, implied volatility, and so on. So for stock price movement, when the stock price moves, it directly affects an option's intrinsic value. For time decay, time is always ticking, and even if the stock doesn't move, your option is slowly losing extrinsic value. And this is why options can go down in price even when nothing on the chart has changed. Every day, a small slice of the premium disappears, especially for short dated contracts. Implied volatility, this is where things get tricky and where traders often get surprised. Implied volatility can rise or fall based on news, sentiment, or even rumors. If implied volatility goes up, premiums inflate, even without price movement. If implied volatility drops, premium deflate, sometimes even sharply. And so this is why options often lose value after earnings, even when the stock moves as expected. And basically changes in implied volatility are kind of like invisible on the price chart, but they're very real on the inside. It's like within the option chain. Also, supply and demand. Like anything in the market, options prices also respond to trader behavior. If everyone's piling into the same strike, let's say a popular weekly call, increased demand can push the price up, even if implied volatility and the stock prices are steady. And the option chain is like a live marketplace, and a bid-ask spread can shift in real time. Even 10 seconds of hesitation can kind of mean like getting filled at the different prices, especially on volatile names. And so kind of to answer the question, so why does your options value change movement to movement? Well, it's part of the stock price, part of the time decay, part of its volatility, and part of it's simply how many other people want that contract or don't.